few months ago, I was speaking with a gentleman called Tom who said, James, I'm planning on retiring next year and I need to work out the best way of creating an income from my investments. I've heard about the 4% rule and then creating an income by selling down my investments as and when I need income, but only drawing 4% seems pretty low. And as someone who has been a good saver all of my life, I'm struggling with the idea of selling down my assets. What seems much more natural is instead to invest in high dividend paying stocks or equity income funds, some of which are offering yields of 5 or 6%. This seems like a much simpler way to create a higher income that I know is likely to be sustainable and protected from inflation. I also think that having that income coming in would really help me psychologically as I transition from being a saver to a spender. So what am I missing? Why would I not follow a dividend income strategy? As a financial advisor, this is a question I get from almost every retiree that I work with. When you're looking to replace your income from work, the natural default position is to want to recreate those reliable cash flows, but from your investments, which leads people to hunt for investments that provide high levels of income. But this is a trap that often leads to excessive risk-taking and poor outcomes in retirement. The best way to unpack what's going on here is to take you on the journey that I took Tom as we investigated this dividend strategy, but ultimately found a better, simpler strategy for him to create income that would enable him to spend even more in retirement without taking anywhere near as much risk. When we spoke, Tom was 60 years old. He had £250,000 invested in a defined contribution pension and £50,000 in an ISA. And he was looking for a yield of 6% or £18,000 per year from his portfolio. 30 years ago, this would have been relatively easy to achieve because back then, bond yields and the dividends that companies paid were much higher. In 1991, if you had a simple, globally diversified passive portfolio of 60% stocks and 40% bonds, that would have yielded almost 6% per year. But since then, yields have fallen dramatically, so that today, even with the recent uptick in interest rates, a 60-40 portfolio is only yielding 2.3%, which for most people, including Tom, is nowhere near enough to live off in retirement. So to achieve his targeted income of 6% or £18,000 per year, we're looking at two options. The first is building a concentrated portfolio of high dividend paying stocks, or a total return approach where we're agnostic to dividends and invest in whatever we think is going to deliver the best total return, and then create our own income by selling assets as and when required, which is the part that Tom didn't feel comfortable with because he was concerned he might end up drawing too much from his portfolio and jeopardizing his retirement, especially as he'd read online that with a total return approach, he may only be able to draw 4% per year if he wants to avoid running out of money in retirement. However, that is a misconception that I'm going to come back to in a second. So I started by asking him, would you prefer a portfolio that, say, delivers a 7% average annual total return, with 6% of that coming from dividends and 1% from capital appreciation, or one that delivers a 8% return, but only 2% of that comes from dividends? Well, there's two things at play here. Of course, I would prefer a higher total return, but I've seen evidence that dividend income strategies have outperformed traditional index investing on a total return basis too. And secondly, it's not all about total return, it's about when that return shows up. One of my key concerns is being forced to sell assets when markets are down to fund my expenditure. But if I have a dividend income that keeps coming in, surely that will protect me from having to sell assets when markets are down. These are both really good points. So let's start with that first one, because this often trips people up. If a company chooses to pay a dividend, is there any reason we should expect it to deliver a higher total return than a company that doesn't? Let's go back to basics. Say a company has a share price of £9 and you hold 10 shares in that company, and over the course of the year, it makes profits equivalent to £1 per share. All being equal, the share price of that company should rise to £10, leaving you with £100 in stock. The company then has three options. It can either reinvest those profits back into the business, or if it can't find anything worth investing in, it can pay those profits out to shareholders, which could happen either by a share buyback, where the company uses profits to buy its own shares back from shareholders. If they did this via a tender and you decided to opt in on a pro rata basis, they would end up buying one share off you, leaving you with £10 in cash. In theory, the stock price would remain the same because although they have paid out £1 per share of profits, they have also reduced the number of shares in issue by 10%. Or they may choose to pay profits out via a dividend of £1 per share, giving you £10 in cash, but as a result, the company's share price would fall by £1. The key point here is that if a company chooses to pay a dividend, it does not leave you any better off. They are simply paying your own money out to you, which surprised Tom. But if stock prices fall when dividends are paid, surely we see sudden overnight drops in stock prices all the time. Well, we do. They're just hard to see because stock prices move around for so many other reasons. Just take a look at this. Here we have the historical stock prices for a company that has been paying large dividends. In the first column, we can see the price the stock opened at in the morning. And in this column, we can see the closing price later on in the day. You'll notice that there tends to be small differences between the close price at the end of the day and the opening the following morning, which is often due to overnight sentiment changes or out of hours trading if it's a US stock. But these moves are typically quite small. However, on the 26th of March, the stock closed at 217.51, but opened up the following morning down to 203.30. That's a 6.5% drop of 14.21p, which is almost all explained by the 13.5p dividend that was paid before markets opened that morning. When a company pays a dividend, its stock price falls by the amount of the dividend. That is a fact. And the same thing happens with funds and ETFs when they distribute income. So going back to our options, if a company chooses to reinvest its profits, but you need income, you could create your own income just by selling a share and you being in exactly the same position as with a dividend. Unless, of course, you have to pay tax when you sell the share or if you receive the dividend, or there are other transaction costs involved. In many jurisdictions, dividends are taxed at higher rates than capital gains, which is why many investors prefer share buybacks to dividends. In Tom's case, however, he's investing inside an ISA and a DC pension, which means that he won't pay tax on dividends or capital gains. So from Tom's perspective, looking at these three options, there is no reason we should expect a company that pays a dividend to deliver a higher total return than a company that doesn't. With this in mind, let's think about Tom's second question. If a company pays out a dividend, will that protect him during a market crash by preventing him from having to sell assets to fund expenditure? Let's say that in scenario A, Tom invests his £300,000 into a high dividend portfolio that is yielding 6% or £18,000 per year. Whilst in scenario B, Tom invests in a portfolio that is otherwise identical but does not pay out income. Then over the next year, the market unfortunately crashes and both portfolios fall by 50%, leaving him with £150,000. In situations like this, it's likely that some companies will cut their dividends, but let's assume that they don't, and again, they pay out £18,000. As we now know, this would reduce the value of his remaining shares, leaving him with £132,000 invested and £18,000 in cash, which is exactly the same as if Tom has decided to sell £18,000 of shares from his non-dividend portfolio. So the answer is no. A company paying a dividend does not protect you from eating into your capital any more than a company that doesn't. So with this in mind, I asked Tom, are there any reasons why you would still prefer a company that pays a dividend to making your own dividends by selling shares as and when you need them? Okay, I see your point. A dividend is just moving my own money from one pocket to the other. However, from my perspective, there would still be two advantages. The first is that I expect the executives of these companies to only pay out dividends that are likely to be sustainable, which would make me feel much more confident spending that money compared with making that judgment myself. Secondly, having that regular income coming in would help me to better manage my cash flow. And what I still don't understand is if dividends are irrelevant to total returns, why are there all of these dividend income strategies that appear to have delivered higher total returns over the long term? And he's right. As you can see here, over the last 60 years, US companies that pay high dividends, which you can see in green, have significantly outperformed companies that have paid low or no dividends. And this is a logarithmic scale, so that is a big difference. However, the reason for this outperformance actually has nothing to do with dividends. But before I explain what's going on here, I first want to address Tom's other points, because I don't think a dividend income would be as useful for managing cash flow as he thinks. Firstly, the dividends you receive will vary over time, as will your desired expenditure. Perhaps you might be planning on spending more in those first few years of retirement and less later on. Or you may have lumpy one-off costs like big holidays or refurbishments that you need to make to your home, buying a car, things like that, which means that your income and outgoings are unlikely to match perfectly. It would be very strange to let an income that is being paid out by someone who has no regard for your goals or financial plans dictate the way that you live your life. So unless the income your portfolio is generating is really high, you're going to need to get used to selling down assets at some point anyway, especially if you want to be tax efficient. For example, in the first few years of retirement, it may be more tax efficient to prioritize drawing money from your pension and perhaps little or nothing from your ISA. So the income that is produced within each account is largely irrelevant. But I guess I could use the overall yield of the portfolio as a guide to what I can draw sustainably overall. Well, yes, you could, but I don't think that would be a very efficient way for you to make the most of the assets you have. Firstly, to achieve a 6% yield, you're going to have to build a highly concentrated portfolio that may expose you to excessive risks, which we'll talk about in a second. Secondly, if you go through life only living off the income your portfolio produces and never eating into the principal, then the only person who wins is the taxman, because you're potentially leaving a lot of money on the table that could have been enjoyed earlier in life, perhaps by spending more money at the start of retirement or giving it away when your children need it the most and you're alive to see them benefit from it. So you're saying that I could potentially draw more than 6% from my portfolio. That is exactly what I'm saying. Let's think about this with a simple example. Say Tom wanted to spend £18,000 per year, adjusted for inflation, for the rest of his life. Initially, all of that is going to need to be covered from his investments. But assuming he gets a full state pension, when that comes online at 67, it's going to do a lot of the heavy lifting. What's more is that he may end up spending less in later life as he starts to slow down. All of which means he may be able to draw even more from his portfolio at the start of retirement. To assess how much more Tom might be able to spend, we can use software to stress test this plan against over 100 years of historical stock market and inflation data. Assuming that he was instead invested in a globally diversified passive portfolio of 60% stocks and 40% bonds, we could bump up his spending to £23,000 from the start of retirement, again increasing that in line with inflation each year, and then £15,750 from 75. And that would have been successful in 87% of historical scenarios, whilst in the other 13% of scenarios, he would have run out of money unless he reduced his expenditure. And as you can see, in the majority of these scenarios, he's still left with a significant sum at the end of the plan. And again, these figures are adjusted for inflation. We need to remember that here we're looking back into the past as a guide, but the future could look very different. And in reality, Tom's plan was a lot more complicated than this. But this simple example demonstrates how important it is not to let your life be dictated by the income that your portfolio produces. Instead, the income you choose to create should be dictated by your goals, other assets and cash flows you expect in the future. This is one example of how retirees who obsess over income and hunt for yield can end up making suboptimal decisions. But I think the biggest risk is that it leads to an overly complex portfolio and excessive risk-taking. As an example, of the 503 companies currently in the S&P 500, over the last 12 months, only 28 of them have been paying dividend yields of 5% or above. On a market capitalization weighted basis, those companies make up just 2% of the S&P 500. Of course, I would expect dividend investors to also look outside of the S&P 500, but this is an example of how using dividend yield as the filter by which you select your investments can lead to a highly concentrated portfolio where you may be taking on an unbearable amount of risk. Yes, there may be a behavioral benefit to seeing those dividends coming in, but you also need to be prepared that a concentrated 100% stock portfolio could see drawdowns of 40, 50%, perhaps even more in the future. And because your portfolio is so different to the index or the market, it may outperform or underperform drastically for long periods of time, which may make it even harder to stick with. Which leads us back to this. If dividends are irrelevant, why is it that companies that pay them have tended to outperform companies that don't? Well, this is a classic case of assuming that correlation equals causation. Because when you dig deeper, you realize that this outperformance isn't really about dividends. It's about the kinds of companies that tend to pay them. Dividend payers are often value stocks, trading at lower prices relative to their earnings or assets. They tend to be profitable companies that usually generate steady cash and have strong balance sheets. And they also tend to be in defensive, lower risk sectors like utilities and consumer staples. And as numerous studies have shown, companies that express these traits have tended to outperform companies that don't. But once you adjust for these factors, the dividend magic disappears. In fact, dividend portfolios don't appear to produce any extra return beyond what these traits already explain. So although a dividend portfolio may inadvertently give you exposure to some companies that have these traits, not all high dividend payers do have these traits. And there are lots of companies that do have these traits that are not dividend payers. So if you wanted to get exposure to companies that express these traits, a dividend portfolio would be a very inefficient way to do it. And that's something that you'd only want to do in the first place if you have a very high conviction that these traits will outperform in the future, because there's no guarantee that they will. In fact, many of these factors have underperformed over the last 10 years. I left this part to the end because I know it's likely to leave you with more questions than answers. And if you want to learn more about factor investing, I've left some resources in the description of the video. But what I wanted Tom and you to take away from this conversation is that although a dividend income strategy may have some psychological benefits that are attractive at the point of retirement, remember, a dividend is just somebody else moving your money from one pocket to another. And if you want to make the most of the money that you have, you're going to need to get used to selling your investments anyway. And most of all, optimizing for income can lead to overly complex, concentrated portfolios and excessive risk-taking, which often leads to lower returns compared with a total return strategy where you're using a simpler, more diversified portfolio with an appropriate level of risk and then creating income by selling assets as and when you need to. The drawback, however, is that if you want to avoid running out of money in retirement, you will need to work out how much you can draw sustainably each year, which is why you need to watch this video here where I show you an example of how to do exactly that.